Just when markets thought they understood the playbook, confusion exploded across every major economy. The Fed is still talking rate cuts, but U.S. growth is stalling. Housing just hit a 5-year low, and retail sales collapsing. In Europe, central banks are going their separate ways, some cutting, some pausing, while trade tensions rise and investor confidence splits like a fault line. Japan's inflation shock challenges the BOJ's patience. China's recovery, fragile at best. One good data point, 3 red flags, and property, still sinking. Markets want cuts, but the data says slow down. So where does that leave us? Hanging, right on the edge of a global divergence moment. This week's podcast breaks it all down, region by region, risk by risk. And at the end, we give you the top 5 global macro risks that could rock the markets in the days ahead. If you're investing, advising, or just watching markets, this is the edge you need. Hit play. Stay to the end. Know what's coming before the markets react.
Wow, what a week it's been.
It really has.
Investors globally were really grappling with a complex web of signals. You had cryptic messages from central banks, economic data doing unexpected things, and, even a glimmer of hope geopolitically.
Definitely a lot to process.
If you felt like you needed a decoder ring just to keep up, you were not alone. But don't worry, we're here. We're your shortcut to understanding what truly moved the needle. Okay, let's unpack this.
Yeah, it was certainly a fascinating week, showing that inherent tension between market expectations and, economic reality. A lot of people looking for clarity probably found more questions than answers.
That sounds about right.
So to really make sense of it all for you, we're going to break it down. We'll look at the action region by region, then peek at what's coming up next week, and finally boil it all down into the top 5 critical areas you really need to keep an eye on.
That's the plan. So the big theme this week felt like global markets were sort of dancing to a pretty mixed tune, wouldn't you say?
Absolutely. A discordant tune is a good way to put it.
We saw investors digesting, fresh guidance from the Fed, those renewed hopes for Middle East peace we mentioned, and then bam, a batch of genuinely worrisome economic signals. It's getting clearer, I think, that while rate cuts are still on the table, the talk is there. Growth projections pretty much everywhere took a haircut.
A significant one in some cases.
And some key economic indicators were, frankly, flashing warning signs. You couldn't ignore them.
And this wasn't just a U.S. story either. Overseas, most central banks basically held steady, but they were dealing with increasingly different inflation trends, persistent trade tensions too. All that kept volatility simmering, made it tricky for policymakers.
Right, a tricky landscape. So let's zoom in from that global view. Let's start our regional breakdown right here at home in the U.S. markets. Here we saw, a steady Fed, but shaky growth signals and a kind of soft close for the holiday-shortened week.
Yeah, the numbers weren't exactly screaming higher.
The S&P 500 slipped just 0.15%. The NASDAQ, it managed a tiny gain, 0.21%, and the Dow was essentially flat, up like 0.02%.
Basically unchanged.
And the indices were really jumpy, swinging on every Fed headline and, of course, those Middle East developments.
Well, what's truly fascinating here is the Fed's balancing act. As everyone expected, they kept the federal funds rate unchanged, 4.25% to 4.5%.
No surprises there.
But their updated projections, they painted a much more cautious picture. They actually lowered their 2025 growth forecast, and they nudged up their inflation and unemployment forecasts.
Okay, so gloomier outlook.
Right. But here's the kicker. Despite these, more pessimistic assumptions, they kept their forecast for 2 rate cuts this year, still penciling them in.
That's the disconnect, isn't it? And then late in the week, we got a bit of a boost, maybe some relief, when Fed Governor Christopher Waller mentioned a possible July rate cut. That definitely helped Friday's bounce.
It did provide some temporary relief.
But with retail sales falling hard and housing starts hitting a 5-year low, is that market relief justified? I mean, does the Fed really have room, or is it just wishful thinking given the actual economic numbers?
That really is the million-dollar question, isn't it? Waller's comments certainly sparked some hope, but yeah, they clash pretty sharply with the data we've been seeing.
How so?
Well, take retail sales. They fell 0.9% in May. That's the second straight monthly drop. Not a great sign for the consumer.
Okay.
And maybe even more concerning, housing starts just plunged. Nearly 10%. That's a 5-year low. Builder sentiment sank to a 1.5-year low.
Wow.
These aren't just little blips, right?
Yeah.
They show a real slowdown in key sectors that are very sensitive to interest rates. So while the market wants to believe in a dovish Fed turning soon,
The data is screaming caution.
exactly, the data is telling a much different, more cautious story.
And in response to all this uncertainty, we saw that classic flight to safety. Treasuries gained, yields went lower. Credit markets, interestingly, held up okay, though high yield softened a bit, probably reflecting that equity choppiness.
Some risk off there. So the crucial insight for you here, for listeners, is that investors are really holding tight to the Fed's dovish signals. They're almost willing those rate cuts to happen.
Fingers crossed, basically.
Yeah, but this stream of weak economic data retail, housing, it's undeniably sharpening concerns about a broader economic slowdown. That disconnect between the market's optimism and the economic reality, that's where the next potential shock could come from.
A widening gap. Okay. So from the U.S. and its tug of war, let's shift over to Europe. The story there this week felt even more fragmented, different central banks doing different things, mixed data.
Very much so.
European stocks fell pretty much across the board last week. The Stock Ops Europe 600 down 1.54%. Germany's DAX slipped 0.70%. The CAC 40 in France lost 1.24%. And London's FTSE 100 declined 0.86%.
Yeah, broad weakness.
It really felt like geopolitical risks popped back up, and the macro data was just confusing, a mixed bag.
Exactly. And you saw real central bank divergence. Well, the ECB, the big one, stayed on pause.
Holding firm.
We saw the Swiss National Bank cut its rate to 0, and Norges Bank in Norway delivered its first cut in 5 years. Both were fighting strong currencies and slowing inflation. Shows very different pressures within Europe.
So they're cutting while the ECB waits.
Right. And it raises an important question. How much pressure did these differing paths put on a major player like the ECB that's trying to hold the line for the whole bloc?
Interesting point. Now, over in the UK, there was some slightly better news on inflation anyway. Annual CPI eased to 3.4%. Services inflation slowed down, which the Bank of England wanted to see.
That was welcome news for them.
The BOE also stayed on hold, but they did signal a gradual path lower for rates. So cuts are on their mind, too, eventually.
And we also saw some interesting sentiment shifts on the continent. German investor morale, that ZEW index, which tracks the economic sentiment, it actually jumped quite a bit.
Oh, really? Why?
Optimism about potential fiscal stimulus there. But contrast that with France, where manufacturing confidence slipped again. That's a worry for the Eurozone's industrial core.
So Germany up, France down. Mixed signals again.
Precisely. And looking bigger picture, the Eurozone's current account surplus halved from a year ago. That largely reflects some tariff-driven front-loading of goods back in Q1.
Pulling demand forward.
Exactly. And it raises a question about the long-term health of Europe's trade balance, if this trend continues, especially with global trade tensions still high. So ultimately, for listeners, the core message for Europe is it remains incredibly fragmented. You've got softening inflation, some modest stimulus measures here and there.
It's patchy.
Very patchy. It's offering only inconsistent support for growth. And this forces individual countries into different fiscal and monetary paths, which could actually worsen the gaps between European economies, not heal them.
More divergence ahead, perhaps. Okay, let's turn our attention now to Japan. The yen slipped this week, but the Bank of Japan. Cautiously steady. Interestingly, though, Japanese stocks actually climbed despite the currency headwinds and global uncertainty.
Resilient performance there.
The Nikkei 225 was up 1.50%. The TOPIX gained 0.54%. The BOJ seems to be walking a very fine line.
Their actions were quite telling. They left rates unchanged, as expected, but they notably slowed down their planned taper of buying Japanese government bonds, JGBs.
What was the signal there?
Well, the move was clearly aimed at easing concerns about tightening monetary policy too soon. Basically buying themselves more time, playing it safe.
Got it. But global worries are still out there. The U.S. and Japan, they failed to reach a tariff agreement at the G7 summit. And with those auto tariffs set to rise in July, Japan's trade outlook still looks pretty cloudy. How big a deal is that lack of a tariff agreement for Japan, especially being so export-driven?
It's a significant hurdle, especially for their auto sector. That's a huge pillar of their economy. The threat of rising auto tariffs just adds this layer of uncertainty. It could directly hit their exports to a key market like the U.S. And compounding this, they had an inflation surprise this week.
Oh, what happened?
Core CPI rose 3.7% year over year in May. That was actually above forecasts, mostly driven by rising food prices.
Okay, so inflation's ticking up more than expected.
Exactly. And that could put more direct pressure on the BOJ to actually consider a rate hike later this year. It challenges their current cautious stance perhaps sooner than they'd like. So the key insight here is the BOJ is buying time trying to navigate these global headwinds. But that rising domestic inflation, it might just force their hand and challenge that cautious approach, potentially shaking up the market calm we've seen.
A potential inflection point. Okay, finally, let's dive into China. Here we saw mixed data leading to some continued market malaise. The Shanghai Composite was down about 0.5%. CSI 300 similar. Hang Seng fell more, 1.5%. Investors there really seem to struggle with this confusing mix. Solid retail figures, but weakening property data.
Yeah, it really highlights the dichotomy in China right now. On one hand, retail sales surged 6.4% year over year. Best performance since 2023. A definite consumer pop.
That sounds good.
It does. But on the other hand, May's industrial output and fixed asset investment, they both lagged forecasts. That raises serious questions about whether that retail surge is sustainable.
Meaning the consumer might be okay, but the industrial side?
Exactly. The underlying engines of growth manufacturing investment, they still seem to be sputtering.
And the elephant in the room in China is always property. New home prices posted their sharpest monthly drop in 7 months. It just underscores this deep slump in real estate that won't quit. We've seen various support measures over the last year. Are they just not working? Or is this crisis just too big for current policy?
That's really the core of the issue. Last year's housing support measures, they seem to be losing steam. It suggests the problem is maybe more structural than a few policy tweaks can fix.
Deeper root.
Yeah, the sheer scale of unsold inventory, developer debt, it's immense. And this slump is hitting just as higher U.S. tariffs are adding more strain to the economy.
A double whammy.
Pretty much. So that consumer bounce, while welcome, might unfortunately be temporary. The property sector and overall investment are still weighing really heavily on the recovery outlook. It's a genuinely bumpy road ahead for them.
Okay, so we've covered a lot of ground globally. Felt like a whirlwind. Now, what does all this mean for next week? Let's look ahead. Key economic events coming up June 23rd to the 27th.
Right, looking forward. The U.S. calendar is quite packed, especially for anyone watching the Fed. Wednesday, June 25th, we get Fed Chair Powell testifying before Congress. That could be crucial for insights, maybe recalibrating rate cut timing expectations.
Powell testimony, always key.
Then Thursday, June 26th, brings May's durable goods orders. A strong rebound is expected there after a steep fall. Also Thursday, the final Q1 GDP reading. Forecasts currently see a contraction, minus 0.2%. That number will be watched very closely.
A negative GDP print. Oof.
Yeah. And Friday, June 27th, is big too. May's core PCE inflation, that's the Fed's preferred measure, expected to be flat at 0.1%. Plus, we get personal income and spending data for May. So, a busy end to the week.
Definitely. Okay, over in Europe, Monday, June 23rd, gives us the Germany and UK flash PMIs. That's Purchasing Managers Indices, a key early read on manufacturing and services momentum. Tell us about economic health.
Good leading indicator.
Tuesday, June 24th, we get the Germany IFO Business Climate Index. We'll be watching for any confidence boost there after those tax relief measures. Then Germany GfK consumer confidence is out Thursday, and France flash inflation for June arrives Friday.
So plenty of data points for Europe, too. For Japan and China, though, there are no major scheduled releases next week.
Quieter on that front.
Relatively.
Huh.
But for China especially, it's always critical to keep an eye out for any unscheduled updates. On tariffs, on the property sector, those are flashpoints that can move markets significantly, often without much warning.
Always need to be vigilant with China news flow. Okay, now let's bring it all together. Synthesize this. Here's where the rubber meets the road. The top 5 risks you need to pay attention to in the coming period. This is your essential watch list, whether you're an investor or just trying to understand where things are heading.
Absolutely. First on the list, the persistence of slowing global growth. What's fascinating here is how that softening data, US, Europe, and China, it makes the weight of slowing growth just undeniable, even while markets cling to hopes for future rate cuts.
That divergence again.
It's a growing divergence you just can't ignore.
Mm-hmm.
Second, central bank divergence and inflation surprises. The challenge is these different paths, ECB on hold, SNB, and Norges cutting.
Yeah.
That creates currency volatility, complicates trade, like we saw in Europe.
Mm-hmm.
Plus, you have the potential for unexpected inflation readings, like Japan's core CPI surprise. That could drastically alter policy plans in shock markets. It really raises the question, can these central banks stay on such different paths for long without causing major economic pressure somewhere?
Good question. What's number 3?
Third is geopolitical and trade tensions. These risks are still very much alive. From the Middle East to unresolved tariff talks like U.S.-Japan to new tariffs like U.S.-China. These things can shift market sentiment incredibly quickly, often without warning.
They're not just background noise.
No, they're direct economic catalysts. Fourth, we have to consider the sustainability of China's recovery. We saw that consumer bounce, yes. But can it really offset the deep property slump and that inconsistent investment, especially now under new tariff pressures?
Right.
That property crisis there, it's not just about housing. It hits consumer confidence, bank stability, local government finances. It's systemic.
A lot riding on it.
Definitely. And finally, number 5, the tug of war between Fed expectations and economic reality. Investors are stubbornly holding on to the Fed's dovish tilt, right, expecting those rate cuts.
Counting on them.
But the continuous stream of weak economic signals retail, housing that could very quickly sharpen concerns about a real, broad economic downturn. The market's optimism might be running ahead of the fundamentals, setting us up for a potential, maybe painful, recalibration.
A reality check possibly coming. Okay, so to wrap up the core message from this deep dive, central banks are definitely playing their cards close to the chest. They're trying to manage expectations, aiming for that soft landing.
Walking a tightrope.
But the undeniable weight of slowing growth, that's the central theme dominating global markets right now. And while hopes for rate cuts later this year might offer some psychological relief,
Some comfort, yeah.
the softening data we're seeing pretty much everywhere means investors, and frankly, anyone paying attention, you've got to remain extremely vigilant.
And this really raises an important final question for you to think about. How will the global economy ultimately reconcile this growing disconnect? The disconnect between market expectations for continued stimulus and support and the increasingly undeniable signs of a broad-based economic slowdown.
That is the key tension.
It's a tension that's likely going to define the next few months, forcing everyone to maybe reevaluate what's actually possible.
Exactly. Understanding these deep dives, connecting these dots, anticipating what might be next. That's not just about absorbing facts. It's your strategic advantage in staying truly well-informed in this complex world.
Couldn't agree more.
We'll be back next week to continue helping you navigate it all. Thanks for joining us on
Still watching? Then you're one of us. Someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format. AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.